What details trigger an estate tax audit for exemptions? Imagine you're carefully planning your estate, making sure everything is in order so your loved ones are protected. But even with the best intentions, certain details can catch the attention of the IRS and lead to an estate tax audit. Understanding what triggers these audits is key to avoiding surprises and ensuring your estate plan holds up. One major factor is how assets are valued. If you have tricky assets like artwork, antiques, or collectibles, the IRS will scrutinize how you appraise them. They want to see if the values are realistic and based on accepted appraisal methods. If your valuations seem too low or too high compared to market prices, that could raise red flags. The same goes for privately held businesses or family-limited partnerships, where valuation discounts are often claimed. Overestimating or underestimating, these can invite an audit. The size of the estate also matters. Estates valued near or above the federal estate tax exemption amount, which is currently set at $12,900,000, are more likely to be examined. Larger estates, especially those over $10 million, attract closer scrutiny because the potential tax revenue is significant. If the estate owes taxes or has unpaid taxes from previous years, that increases the chance of an audit too. Incomplete or inaccurate information on the estate tax return can trigger an investigation. Missing details, incorrect asset descriptions, or unreported assets make the IRS question whether the exemption was properly claimed. For example, if a beneficiary is listed in the will but the estate tax return does not include that asset, it raises suspicion. Discrepancies between estate planning documents and the tax return are another common trigger. If a will or trust grants a specific asset to someone but that asset is not reported on the return, or if deductions are claimed for assets not listed, the IRS will want to clarify these inconsistencies. Assets that are hard to value, like closely held businesses or unique real estate, are often flagged. Their subjective valuations can significantly impact the estate's taxable value, so the IRS pays close attention to how these are appraised. Large deductions for charitable donations or other significant expenses can also draw scrutiny if they seem unusually high compared to the estate's size. Sometimes, estates file returns below the exemption threshold to establish a basis step-up for inherited property. While this is common, if the reported values seem unreasonable or inconsistent with other documentation, it can lead to an audit. To stay clear of trouble, it's smart to get professional appraisals for difficult assets, keep all documents organized, and be transparent about all assets and deductions. Proper planning and thorough record keeping help protect your estate from unnecessary audits and ensure the exemption is applied correctly. Being aware of these triggers allows you to prepare your estate in a way that minimizes risks and keeps your estate plan solid.